Why does unemployment rise when inflation falls? Have you ever wondered why unemployment tends to increase when inflation decreases? This relationship is often explained by the Phillips curve, which illustrates an inverse connection between these two economic factors. When inflation falls, unemployment usually rises, and understanding why can help us grasp key economic relationships. At its core, inflation indicates rising prices across the economy. This increase is often driven by strong demand for goods and services. When demand is high, businesses produce more and hire additional workers, which reduces unemployment. As more people find jobs, they have greater bargaining power, leading to higher wages. This increase in wages can raise production costs, which in turn drives up prices, resulting in higher inflation. Thus, low unemployment is typically associated with rising inflation. On the flip side, when inflation falls, it often signals weaker demand in the economy. Businesses may cut back on production and reduce their workforce, leading to higher unemployment. With lower demand, there is less pressure on wages and prices, causing inflation to decline. This relationship is most evident in the short term, where movements along the Phillips curve reflected changes in overall economic demand. When policymakers or market forces take steps to reduce inflation, such as tightening monetary policy, aggregate demand decreases. This drop in demand leads to lower output and higher unemployment, as companies scale back on hiring and production. Workers may experience stagnant wages or even cuts, which further reduces consumer spending and reinforces the cycle of lower inflation and rising unemployment. It is essential to note that this relationship is not always straightforward. Over time, various factors can influence the Phillips curve, such as inflation expectations, supply shocks, and changes in labor market dynamics. For instance, during the 1970s, many economies experienced stagflation, where both inflation and unemployment rose simultaneously, challenging the traditional trade-off. More recently, the connection has weakened, with periods of low unemployment not necessarily resulting in higher inflation. This change may be attributed to globalization, technological advancements, and shifts in wage-setting behavior. From an inflation-focused perspective, grasping this relationship is vital. Efforts to reduce inflation can temporarily lead to increased unemployment. Policymakers must find a balance between controlling inflation and minimizing job losses. The natural rate of unemployment, which is the level consistent with stable inflation, acts as a benchmark. Attempting to push unemployment below this rate may cause inflation to rise, while allowing unemployment to exceed it can help lower inflation. In practical terms, when inflation falls, it often indicates a cooling economy. This cooling leads to higher unemployment as businesses adjust to decreased demand. Understanding this dynamic is central to monetary policy decisions aimed at stabilizing prices while supporting employment.